Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 25th year in business. It's midday, Thursday, October 23rd, and this week's audio blog is titled Pre-Election and FOMC Drama. First off, I cannot emphasize enough how pleased I am with how last week's Miles Franklin Silver All-Star Panel webinar turned out. In this must-hear one-hour discussion with renowned silver experts David Morgan, Harvey Organ, Steve St. Angelo, and Bill Holter, we discussed everything from demand, supply, inventories, production, mining costs, and trading. It's available on the Miles Franklin blog, and we'd love to hear your feedback. And on the topic of podcasts, be sure to tune in for the extremely insightful interview I taped this week with Miles Franklin's president and co-founder, Andy Schekman, regarding our industry-leading storage program with Brinks Canada. This podcast and an accompanying article on the same topic are expected to be published in the next week or so. Now, with that housekeeping out of the way, let's delve into the aftermath of last week's turbulent markets. You can't read my copy, but the word aftermath has quotes around it, as in freely traded markets, there wouldn't be much to discuss. Markets rise, markets fall, and the world moves on. Economic activity doesn't materially change, certainly not when stock indices fall a whopping 9% from all-time high levels. And for those that lost money, well, too bad. That's just what happens when you gamble. Just as the best baseball players get a hit only 30% of the time, the best investors in freely traded markets typically are right no more than 55 or 60%. Of course, we don't live in a world of freely traded markets. In fact, the polar opposite exists in 2014's bizarro world of 24/7 operation by the President's Working Group on Financial Markets, the Federal Reserve, the Exchange Stabilization Fund, and the Gold Cartel. Not only is every tick of major indices like the Dow Jones Propaganda Average, the 10-year Treasury yield, and the gold price managed, but if they even remotely act against the power that be's wishes, all manner of damage control is executed, from heightened manipulation, accelerated propaganda, pitiful jawboning, and even official policy changes. Again, we cannot emphasize enough the fact that the Fed could not care less about the economy. As if they were truly targeting full employment and stable prices, their level of incompetence would be historic in scope. To the contrary, the Fed cares only about financial markets, and with them, the 1% that benefit from asset price appreciation. In doing so, the banks that own the Fed are enriched to the detriment of everyone else, while the status quo they lord over is maintained in the ultimate can-kicking exercise. Of course, when they inevitably lose control of the rigging, as they always have throughout history, the feedback loop catalyzed by falling stock, real estate, and other asset prices exposes their fraud entirely, forcing them to openly admit failure and increase monetary stimulus until eventually the same hyperinflation that's destroyed all other fiat currency regimes arrives. And of course, if the financial world's Achilles heel, i.e. physical gold and silver, breaks the cartel's chains and surges to proper market clearing levels, history's largest fiat Ponzi scheme would instantaneously implode. In executing its evil plans, what the Fed says and does are two entirely different things. In other words, given the massive amount of proof stating otherwise, it's utterly baffling how many people still take the Fed's words at face value. I mean, it's bad enough that people could care less what their eternally overstated, heavily biased economic forecasts depict, as frankly, it would be difficult to find an institution, let alone one staffed with so-called financial geniuses, with a worse track record. However, it's even more amazing that people actually believe the Fed is doing what it says, when we clearly know otherwise. To wit, the 16 trillion of secret loans they handed out to everyone from the Greek government to Toyota Motors in 2009 is now public record, as are the off-balance sheet swap agreements they've had with European banks since 2010, enabling them to avoid both ECB regulations and Fed balance sheet disclosure. Just look at any FOMC meeting and you'll see that they are constantly ratifying the extension of these agreements. Or for that matter, what I wrote in Proof of the Tapering Mirage last year of how the Fed's own footprints revealed that during 2013, they were QEing far more than they stated, to the tune of closer to 130 billion per month compared to the official level of 85 billion. And heck, that's before the Chinese started making significant Treasury sales at year end, just before Belgium magically stepped up to the plate to purchase hundreds of billions of treasuries, amounting to nearly their entire GDP. That was when the Fed was doing whatever it takes to prevent the 10-year yield from rising above 3.0%, as I wrote last year in 3.0% Enough Said, as opposed to today when they are doing whatever it takes to prevent rates from falling, thus exposing what I deemed last May the most damning proof yet of QE failure, i.e., plunging rates despite supposed recovery and tapering. Back in May, I wrote 2.6% Enough Said to highlight their blatant attempts to prevent rates from plunging below the key support level of 2.6%. And today, my similarly themed article was titled 2.2% is the new 2.6%. To understand why such market manipulation occurs from west to east has grown so egregious, simply look around you. It's not just hearsay that the global economy is imploding. Whilst debt explodes, the cost of living surges, and currency volatility jumps off the charts. And regarding the latter, we deem the currency volatility inherent in fiat currency regimes the, quote, single most bullish precious metal factor imaginable, in that it not only causes massive inflation surges the world round, but makes it nearly impossible for corporations to make long-term business plans, and of course, invites an equally ugly feedback loop of currency devaluations as the final currency war accelerates toward its inevitable, horrifying end. Conversely, in yesterday's volatility fallacy, I mocked the propaganda of record high volatility amid stock markets barely off all-time highs, with not a single daily decline of more than 2%. And of course, the flat-out lies about precious metal volatility, given they are never allowed to rise as fast as they fall, with essentially all volatility events to the downside 99% of the time at the same 2 or 3 key attack times. And the number one key attack time, of course, as we saw today again, the 10 o'clock a.m. Eastern Time close of the global physical markets. As for the real world, look no further than collapsing commodity prices to realize just how rapidly economic activity is unraveling. The CRB Commodity Index is down 13% in the past 3 months alone, on the verge of breaching its pre-QE3 levels from mid-2012. Not that anyone's cost of living has materially declined, contrary to the MSM's relentless propaganda of consumer relief of falling gasoline prices. Gas is still above $3 a gallon here in the States, and given that every other aspect of my personal cost structure is rising, the trend remains relentlessly upward. This month alone, Comcast added $5 a month to my cable internet phone bill. ADT added $5 a month to my home alarm bill. Lifetime Fitness added $5 a month to my gym bill. And Geico added $50 per period for my auto insurance renewal. It's a good thing for Democrats' election prospects that the publication of Obamacare's 2015 rate changes are being conveniently delayed until November 15th, which likely will be significantly higher as well. And of course, the economic positives generated by falling oil prices will be more than offset by the negatives, starting with the global impact of weaker industrial activity, and thus taxation revenues for the government. But even more ominous, as I wrote in last week's Collapsing Oil Prices Portend Unspeakable Horrors, the upcoming energy industry layoffs will make it quite difficult for the Fed to accomplish its full employment goal. And oh yeah, the massively depleting, heavily over-leveraged U.S. shale oil industry will no doubt implode. And when it does, it will join the other Wall Street funded illusion, housing, in ratcheting down GDP expectations. To that end, watching the MSM crow about higher housing starts last week, when the incremental growth was all in rental properties, I'm truly amazed at how shallow their supposed analysis is. Residential home sales, permits, starts, and mortgage purchase applications are as dead in the water as could be imagined, even with mortgage rates near historic lows. And worse yet, the record high rents caused by countless millions losing their homes, which in turn fueled the Fed-funded buy-to-rent boom, are already starting to roll over. In other words, the market is not only structurally broken, but on the precipice of a dramatic plunge. Even the heavily biased NAHB Housing Sentiment Survey plunged last week, and yet the aforementioned housing recovery propaganda continues. As for this month's market movements, they have been truly terrifying in Europe, where even large stock markets like Germany's DAX and France's CAC fell by 15%, whilst pigs like Greece plummeted closer to 35%. And even more worrisome, pigs' bond yield surged last week amidst the chaos before somewhat settling down when the various manipulation mechanisms swooped in to the rescue. The Dow Jones Propaganda Average declined just 9% from top to bottom, care of relentless PPT support. But like Europe, plunging interest rates told a far dire story. The 10-year yield bounced from its liquidity vacuum bottom of 1.9% last Wednesday, but at 2.25% today is as low as it's been since June 2013, just before the Fed's so-called tapering commenced. And of course, despite this morning's news that Saudi Arabia cut production by a whopping 300,000 barrels last month, which I say facetiously, oil prices remain at just $81 a barrel, screaming worldwide recession as loudly as possible. Next Wednesday, the FOMC meeting has been widely telegraphed as the end point for QE3. That is, it was until last week's equity plunge, which, as discussed in Friday's Manipulation, Jawboning, and Prayer, prompted no less than 6 Fed governors to hint at, or in some cases blatantly call for, a delay in QE's end, as well as equally blatant calls to extend the already considerable time before rate hikes even longer. And never forget that just 6 days later is the all-important midterm election, in which the Democrats are desperate to maintain their narrow Senate majority. Not that anyone really cares anymore, except the Democratic politicians themselves, now that America has plunged into a one-party fascism in which the two major parties are virtually identical. However, as we learned too well before the 2012 election, when a Census Bureau whistleblower admitted orders to rig the October 2012 NFP report to place the unemployment rate exactly 0.1% lower than when Obama took office, the current administration will do whatever it takes to paint the tape in front of the November 2014 elections. And this, of course, includes making sure the Fed doesn't look foolish a week beforehand, and by all means, making sure stock markets stabilize. This is why they have miraculously recovered nearly all their losses this week, via 5 straight dead ringer algorithms, despite not a shred of materially positive news. Note the reaction to this morning's terrible PMI manufacturing reading, with stocks surging still higher and gold viciously attacked. As for precious metals themselves, global demand has never been higher, but particularly this month, given enormous buying by China, Russia, and India, huge drawdowns in the GLD ETF, and of course, U.S. Mint Silver Eagle sales on pace for their third best month ever, and their best non-January month, as January is typically the strongest month of the year due to year-end backordering of the next year's issuance. The dichotomy of paper silver prices has become so outlandish, it's hard to believe it hasn't yet been resolved by economic Mother Nature. Last year, for example, paper prices were smashed by 35%, but physical demand hit a record level. This year, they're down another 12%, yet physical demand, will likely end 2014 at roughly the same level as 2013. And no, increased supply is not an issue, as supply is not only barely rising, but on the verge of dramatic declines due to a combination of capital strangulation, lack of new discoveries, surging mining costs, and low prices. In other words, a perfect storm is brewing for precious metals, and not just economically, but geopolitically as well. Cumulatively, it is difficult to conclude anything other than that something extremely economically and financially wicked this way comes. Perhaps catalyzed by the November 9th Catalonia-Spain secession vote, or maybe the potentially cataclysmic November 30th Swiss gold referendum, in which initial polls shockingly revealed this week that the yes camp is in the lead. And when it does, the ensuing global stagflation and unrest will likely be unprecedented. Thus, we cannot be more vehement in our belief that this may be your last chance at financial survival. And for those taking the initiative to protect themselves with physical precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.